I have this. Like, this is what they sent me over at the beginning. But then I wanted to this is very like these are the requirements. Then this is what it was changed to. And this is what I had to change it to again. Yeah, true. Store. I don't know, like,
Okay, hello everyone.
Just like listing things off.
Carry on with our M&A discussion, and we're going to talk about non-taxable acquisitions. So this is a form of M&A where the transaction is conducted in such a manner where the parties in the transaction do not pay tax. These are some of the bigger transactions in the marketplace. And again, so what you would expect to see in these transactions is either no or a very small amount of cash involved in the transaction. If the transaction completely involves cash, either because that's what the buyer wants in the transaction or because that's what the seller wants to pay, then you are not in these roles. You are in a taxable transaction. That's what we talked about on Monday, which is you have a taxable acquisition of assets or a taxable acquisition of stock. Okay. So we're going to talk about non-taxable. So the tax law allows taxpayers to reorganize the business in a non-taxable manner in certain instances. The term reorganization is broad and can encompass both external acquisitions of corporate stock or assets and internal restructuring of assets and business. So a reorganization is a tax-defined term, but it can mean an external transaction when we're acquiring assets or stock in a non-taxable manner. And we're either on the acquiring side or the seller side. But it can also be a restructuring within the business. So nothing happens outside of the larger organization. This happens when when an organization might want to restructure divisions or segments of their business. Many times they're moving assets and stock around in their organization. You do that, even though it's all within an organization, you can do that in a taxable manner. This allows you to do that in a non-taxable manner. Many times I've seen, like when I was mentioning the third-party transactions, you might be automatically in a taxable transaction because either the buyer wants to pay cash or the seller wants to receive cash. When you're doing internal reorganizations, there is a very high degree of reluctance to pay tax. You're doing an internal transaction, and you want to do that to the extent possible with the least amount of tax. Because if not, what you're doing, think about your global effective tax rate. Take a circle and draw it around your org chart. All the entities in there are all in one financial statement. So you're reshuffling internally to reorganize your divisions or your segments. None of that has an effect on your global income, right? Because accounting is going to eliminate all of that internal transaction. If you do those transactions and you trip tax, you trigger tax on some of those transactions, you're just increasing your effective tax rate. That's not going to make the CFO very happy at the end of the day. We didn't get any additional income and my tax rate went up. So you need to be very adept in doing those types of internal transactions qualifying for non-taxable treatment. Consistent with the policy underlying Section 351, remember that was our seminal tax code section for the transfer of assets into corporate form. The non-taxability of a reorganization is predicated on the taxpayer maintaining continued ownership in the stock or assets transferred. How did they do that? Indirectly through the ownership of the acquiring corporation stock. So that same premise, right? We transferred assets to a corporation for corporate stock. I still have line of sight to those same assets. What I own directly, now I own indirectly in the 351 context. Here you'll see in these transactions, I still have line of sight to the assets through the acquiring corporation stock that would be received in the transaction. If I receive cash, right, I cut off that ability to have any line of sight to the asset. That's the seminal reason why it becomes taxable. Okay. The tax code provides non-taxable treatment to the corporation and the shareholders involved. These are the parties to the reorganization. So I'm gonna be very methodical when we go through this. You need to be methodical going through this. Go through each party to the reorganization. If you start like jumbling it all together, you're just gonna get confused and you're gonna apply the different rules to the wrong parties. So just go through each party. We're gonna talk about the taxability to that party, taxable or not, and we're gonna talk about the tax basis implications to the transaction that they were involved in. But when I say parties to the reorg, that means everybody who is a stakeholder, who is the taxpayers in it. You're gonna have the acquiring corporation, you're gonna have the target corporation, you're gonna have acquiring corporation shareholders, you're gonna have target shareholders, corporation shareholders. Those are the parties to the reorganization. Okay? And this is non-taxable if the transaction fits one of the statutory definitions and meets all the accompanying statutory and regulatory requirements, right? Transactions are taxable unless the government tells you they are not, right? This is one of those exceptions. We have to meet the requirements that they lay out, or our transaction is non-taxable. Now, the good thing is, we know the rules. They tell us what the rules are. So can we fit our transaction to meet those rules to become non-taxable? The things that will really prevent you from doing that is the business deal, the legal form of the transaction, and the consideration exchange between the parties. Because you can't control that, right? Remember my example of the founder who wants to exit the business and wants cash so he go to the French Riviera? You're not going to be able to change their mind for the tax reasons, right? So it's just within the confines of the legal form of the transaction and consideration exchange, can you fit within one of these definitions and make your transaction non-taxable? You also need to satisfy the judicial doctrines that underlying the reorganization statutes. So we have judicial doctrines, which means this is come from case law. So disputes between the government and taxpayers in the area of reorganizations has developed a well-defined, stable set of doctrines from case law that we also have to satisfy. So we'll go through that towards the end of this section. But you got to meet the statutory, you got to meet the regulatory, and you got to meet the judicial doctrines. All of that in order to be non-taxable. And large transactions, whether something is taxable or non-taxable, has lots of zeros to it. So these are big transactions with lots of dollars at stake. Hence, they avail themselves of lots of consultants, both on the business side, on the tax side, on the legal side, on the treasury side. These are the big life events that are out there because of the states of the transaction. Okay, so. Internal Revenue Code, Section 368, is the statutory definitions for non-taxable reorganizations. When taxpayers refer to something as being a reorganization, a B reorganization, they are referring to the definition under the applicable code section 368A1 blank. Those go through A through G. So when somebody says, I'm doing an E reorganization, that's what they're referring to. It's not some magical code that they have. It's the place in the Internal Revenue Code that they are intending their transaction to meet the definition of and avail of non-taxable treatment. Okay? So I always hear business deal people and they'll say, oh, well, we're doing a B reorganization. They don't even know where the B comes from. But now you know where the B comes from. It comes from the location in 368 in the Internal Revenue Code. We're going to be exploring A and B reorganizations in detail. We also don't have enough time for me to take you all the way through A through G, but you'll get a flavor of what's going on in these rules, and you'll get a sense of how to approach them. I'll give you a framework on how to think methodically through all the parties and the issues for each party. Now there are 7 statutory definitions, A through G. So we're going to do A and B, but C, D are very common. E is very common. It's a recapitalization. So when companies reshuffle their equity, so they go from all common stock to common and preferred, or all voting stock to be voting and non-voting stock. That legal mechanic of reshuffling their equity section, that is what we call an E-reorganization. E-reorganization defines that reshuffling of the equity section, if done in a certain manner, as being non-taxable. Okay? So, give you another flavor, one we're not going to talk about, is a G reorganization. A G reorganization is a bankruptcy reorganization. So when a company declares a bankruptcy, right, their liabilities exceed their assets, so they petition the bankruptcy court to restructure the business. It usually involves creditors becoming equity owners, and equity owners either losing everything or being greatly reduced in their ownership of the business because, right, creditors are higher than equity owners in the hierarchy of liquidations. So that reshuffling of the ownership interests, you can't just like have a note receivable as a creditor and exchange that for stock and that be non-taxable absent the G reorganization provisions. So bankruptcy people, both from a legal perspective and an accounting and a tax perspective, are very familiar with what the requirements are for a G reorganization. But it's basically under the auspices of the bankruptcy court. And that whole restructuring of the ownership of the bankrupt corporation so that it can emerge from bankruptcy can be done non-taxable as a G reorganization. So, Exhibit 812 kind of gives you in English the definitions of all the 7 statutory reorganizations. If you do not fit any of those, you have a taxable event, right? Because it's a finite list. Do these things become non-taxable. If you do something beyond that and you can't meet any one of those definitions, 2 things happen. You either have to restructure your transaction, redesign it, so that you fit into one of them, or you accept taxability. Okay? And many times if you're dealing with a large transaction, lots of zeros, and nobody wants to pay tax, you have to fit into something. So as a tax advisor, one of the things we're doing is what do we need to tweak in the legal form of the transaction or the consideration involved in order to fit one of the definitions. Because I have to fit one of them to be non-taxable. So we're going to start with A reorganization. So 368A1A, and again that's why we call it an A reorganization, are commonly referred to as statutory mergers. So this is one of the things where you got to be careful of people calling it a merger, calling it a joint venture, calling it an acquisition, calling it whatever. That doesn't tell you what it is from a tax perspective. We have to fit one of these definitions. So what the CEO says, oh, we're merging with this company, that's great. And that could be from a big picture business perspective what is happening, but we got to get granular from a tax perspective. Let's talk about the transaction. What are we doing? This is where you're going to see, I like to draw pictures. You get fact patterns on an exam or you're in a conference room and people are talking about a transaction, don't be afraid to draw boxes and arrows. Who's doing what? Where are assets going? Where is stock going? Who's the transferor? Who's the buyer? And don't be afraid to pause people. Sometimes you'll catch them. They may think they know the transaction, but when you get real granular, you can pressure test them. What is the transaction? Who is giving what to whom for what? Okay. So statutory mergers, A reorganizations. These are executed pursuant to state merger law. So states have merger laws, so we are going to follow the state merger laws, and if we do that in such a manner that we're going to talk about here with a couple more requirements, we're going to be able to do that reorganization in a non-taxable manner. So the requirements for A reorganization under the tax code is the acquiring corporation acquires the assets and liabilities of the target corporation. So we're not doing a stock transaction. This is an asset and liabilities acquisition. And so we have two required. The target corporation ceases to exist unless the transaction is structured what we're going to call a reverse triangular reorganization. We're going to talk about here in all of the assets and liabilities of the target become those of the acquiring corporation, and the target ceases to exist as a corporation as part of the combination. Ceases to exist. Its stock is no longer in existence after the transaction. Okay? The consideration that is involved, and I'll show a picture of what the reorganization is in a moment. The consideration that can be paid to the target shareholders is fairly flexible in this arrangement. It can still be an A reorganization. The only requirement is that the acquiring corporation stock must comprise at least 40% of the total consideration paid to the target shareholders, which means that up to 60% can be comprised of non-stock property such as cash. Now, why that's important is if I do receive cash in the transaction, right, throughout everything we've been talking about, if you receive cash, you're going to have a partially taxable transaction. Okay? Because you cannot transfer an asset and receive cash and it be non-taxable. But if you have up to 40% stock, so consideration, think of the buyer. What is the buyer delivering to the target shareholders? If I deliver all acquiring stock, I'm going to be completely in, and I do this via state merger law, and I acquire all the assets and liabilities of the target ceases to exist. A reorganization, everybody's non-taxable. If instead, I don't give all stock as the acquiring corporation, I give 40% of my stock supplemented with 60% of cash. That's the total fair market value of the target. Then it is still an A reorganization, but the target shareholder is going to pay some tax because they got some cash. We'll go through that in a moment. But the real appeal of an A reorganization is the element to get some cash to the target shareholders. Right? Because keep in mind, although I might incur tax in part, lots of sellers, target shareholders in this example, want to have cash at the end of the day. So maybe not all cash, but a significant amount of cash. 60% of the purchase price can be cash in this example. So I recognize some significant element of tax, but I get my hands on cash. Okay, so the authors do a really nice job of depicting this is what I offer you to do on an exam, also do, more importantly, in practice. Draw the transactions that are being discussed so you understand who's doing what, when, and what are they getting. Okay? So this is an A reorganization. So we have a transaction where I have a target shareholder, that is SEDA, circle, that's an individual in an org chart. The target corporation is WB. All right, and these are going to be the examples through the examples in the textbook. So WB is the target corporation. That's who somebody wants to acquire, right? That's the target that you're trying to go after. The acquiring corporation is SCR. Okay? So, and then I draw with arrows who's doing what. So the first transaction, a two-step transaction, is WB assets and liabilities come over to SCR, and SCR stock and cash goes to WB. Okay? And then we know, so that accomplishes the first prong of our requirement. The acquiring corporation, which is SCR, acquires all of the assets and liabilities of WB. Check, we got that one. The second one, the requirement, is WB has to go out of existence as part of the transaction. So, how does that happen? WB, the legal mechanic of that is they deliver what they got in exchange for their assets, the SCR stock and cash, up to SEDA. What does SEDA do? SEDA delivers WB stock back to WB. Under state law, when a corporation acquires all of its own stock as part of one of these transactions, it can cancel the stock and goes out of existence from a legal perspective. Okay? So what happens at the end of the day? The historical WB assets and liabilities end up owned by SCR. And SEDA is a new shareholder in SCR because they receive stock part of the transaction, and they got some cash. Okay? So that's the parties to the transaction. I have three of them. I have SEDA, the target corporation shareholder, WB Target Corporation, and Acquiring Corporation SCR. Okay? And going by party, then I can look at what are the tax implications by party. So I'll start, circled the wrong one there. I'll start with the Acquiring Corporation SCR. So when SCR, by virtue, I've met the two requirements of the A reorganization. I acquired all the target's assets and liabilities, and target went out of existence as part of the transaction. So I'm in the A reorganization world. In that world, it goes by party. It tells me what party to the reorg and what their tax implications are. So SCR, in an A reorganization, the acquiring corporation does not recognize gain or loss in the transaction. Right? They've acquired assets and liabilities, and they haven't disposed of anything but their own stock and cash. That does not require them to recognize any gain or loss. The target corporation in an A reorganization does not recognize gain or loss either. They've delivered their assets and liabilities in exchange for SCR stock and cash, but the second step of the transaction, they delivered that acquisition proceeds up to the shareholder in cancellation of their stock. Okay, so they do not recognize gain or loss. The target corporation shareholder typically does not recognize gain or loss if it's an all stock deal, but if cash is received, they're the ones who recognize some gain in the transaction because they have effectively sold some of their stock investment in WB because now they own cash and not WB stock. Okay? The reason it's not all taxable, because SEDA still has line of sight to some of the WB assets indirectly through their ownership of SCR, the acquiring corporation. They received SCR stock in the transaction as well as cash. That's the reason why some of the transaction is non-taxable to SEDA and some of it is taxable. I got to account for that cash element. But this is the way to approach these problems. If you start looking at the transaction and you say, oh, well, it's a reorganization, it's not taxable. Well, to whom and at which point does it become taxable? Okay, so we're going to go through that a little bit slower now. So in an A reorganization, I'm going to go through each party to the transaction, and I am going to go through it in two manners. I'm going to talk about the taxability to that party, and then I'm going to talk about the tax basis implications to that party. If you go through each party with those two consequences, is it taxable or not, and what is their tax basis implication, you're going to be fine. You're going to be very thorough going through every aspect of the transaction. George, you had a question?
Yeah, on the previous slide.
Yep.
Since SEDA received SCR stock and cash, would it be taxed for the cash?
Yes. Yes. Again, from the perspective of what happened before the transaction, SEDA owned stock in WB. After the transaction, they have stock in SCR, which in SCR has some of the assets of WB, but SEDA also has cash. That cash element's going to attract the taxability to SEDA.
Yeah, the 40% requirement by the IRS, is it for continuity reasons?
Yes. Yeah, exactly.
Okay.
That's the element that says, okay, if I don't get at least 40%, then we're going to make the whole thing taxable, because then you kind of, it looks like you had a bigger sale than that. Now, it is over 50%, right? Because 60% can be cash, but they have the power of the pen. They wrote it at 40%. So as long as it's at least 40% acquiring stock as in the total consideration, then it can be still partially non-taxable. Okay, the other thing I failed to mention here, I always did this little trick. It helped me in analyzing these transactions. I always put a little star in the corner of corporation that is the survivor of the transaction. Okay? Which entity is going to be around after the transaction? SCR is the survivor. You'll do other forms of these transactions that'll be a different entity will be the survivor. But I always like to just not lose sight when I'm drawing the arrows in the transaction. Who's going to be around when the transaction is over? And WB is gone. It liquidates as part of the transaction, right? It ceases to exist. But SCR, as the acquiring company, survives the transaction, meaning it continues on. Okay, so let's go through each party to the reorganization. We have 3 in our diagram. We're going to go through each one of them on a taxability perspective and a tax basis perspective. So the acquiring corporation. So is it taxable or not? The law says no. No gain or loss is recognized by the acquiring corporation. They can acquire the assets of the target corporation, and whether they issue stock or cash or deliver cash, they are not taxable on the transaction as long as it meets the 2 requirements of the A reorganization. So just stop there and think about what is the tax basis implications to them. This is important because tax basis is the hallmark of our deferral transactions, right? That's how the government distinguishes between a transaction that is not currently taxable, but not forgiven, not excused, not any of those, it's just deferred. It's saying, this transaction, as depicted on the first slide, we're not going to tax that currently. But if somebody else does something in the future, I want to revisit my ability to tax that previously realized but not recognized gain. That's through the basis rules, right? So we have that going on here because it's non-taxable. I have to adjust the basis. So the acquiring corporation, the rule for them is they take a carryover tax basis in the target corporation's assets with existing depreciation schedules remaining in place. Right? That makes sense because there was no gain on that asset transfer, right? If I acquired the assets of WB, they moved from the ownership of WB into the ownership of SCR. SCR takes the same basis in the assets that WB had in the assets, right? The assets come over, the basis carries over to SCR. What does that do? That preserves the gain in the assets. Because what if SCR in a year from now sells some of those assets to a third party for cash? The government says, I then want to tax some of that previously realized gain on your A reorg that was not taxed currently. It was deferred. So we preserve that ability to tax that unrecognized gain by carrying over the basis. Okay? So now I'm done with acquiring corporation. SCR, the acquiring corporation, no gain or loss. You take a carryover basis in the assets. You take a carryover basis in the assets. Just keep on doing what WB was doing in their depreciation, right? Wherever they were in the table, they were in year 3. You just pick up with year 3. Start carrying on. Okay. So I'm done with the acquiring corporation. Now let's go to the target corporation. This is WB in our example. WB, no gain or loss is recognized on the transaction. The rule says if I do an A reorganization, I can deliver my assets and liabilities in exchange for acquiring corporation stock and up to 60% of cash. If I deliver those to my shareholder, when I cease operations, I do not have a gain or loss. Okay? So no gain or loss to the target corporation. Tax basis, I put NA because it goes out of existence. Right? No more assets. I transferred all my assets by definition over to CR. Okay, so then that leaves one party, right? Target shareholder tax implications. This is SEDA. Right? So SEDA, no gain or loss is recognized unless food is received. So I could do the A reorganization with entirely SCR stock. Then everybody would have had non-taxable treatment, right? but I have no gain or loss unless boot is received. In cases where boot is received, the target shareholder recognizes gain, but not loss equal to the lesser of gain realized or the fair market value of the boot received. That should sound familiar to you. That's the same rule we talked about when a shareholder receives property in a 351 contribution and receives cash, boot in the 351 transaction. You take the lesser of gain realized or the boot received. Same rule, right? So, target shareholder is the one who, if I have some cash, but not too much cash, not greater than 60% of cash in my A reorg, target shareholder is the one who's going to realize the gain. Okay? Now, the target shareholder's tax implications for a tax basis. So each party of the reorg, we're going to talk about taxability and tax basis. So the target shareholder's tax implications from a basis perspective, they take a substituted tax basis in the new acquiring stock equal to their old basis in the target corporation stock, plus any gain realized, minus any money or and fair market value of other property received. That's the same rule we talked about in 350. Okay. If you go back to slide 21, you'll see this exact chart. But if I had an A reorganization where the consideration was solely acquiring stock, then it's just pure substituted basis. Meaning that my tax basis in the target stock, so SATA's basis in WB, becomes SATA's basis in SCR. Because if I had no cash involved in the transaction, the yellow rows are not applicable. Right? Does that make sense? Yes, because it's a deferral transaction. I'm not currently taxing SATA on exchanging WB stock for SCR stock. But in order to preserve that, because SATA may sell SCR stock sometime in the future, I want to make sure that the gain I had in SCR stock, or gain I had in WB stock is preserved in my gain in the SCR stock. And I do that by taking the basis I had in the WB stock and I substitute that for my basis in the SCR stock that I received. And if I sell it, SCR stock in the future, I recognize that previously realized but unrecognized. Okay. If I have boot in the transaction, then I increase my tax basis in the target stock by the gain realized on the exchange, and then I lower it for the fair market value of the boot received. That's what I have to do when it's involved in the transaction. That is the same basis determination the shareholder makes in the transferee corporate stock they receive in a 351. Hopefully you're starting to see some themes here. The devil's in the details, but this is just the mechanics of deferral transactions. And you don't need to have a full mechanic through the basis if you already recognize some of the gains. And that's just the hallmark of preservation of built-in gain. Okay, let's apply some of this stuff.
What amount of gain will SATA realize on the exchange of WB stock for SCR stock?
So it's up to you, but I would draw this out to make sure I understand what's happening. Who owns what? And who is delivering what to whom? And then what is the question asking me? Is it asking me about the target corporation? Is it asking me about the target shareholder? And you can even label who the parties are, right? Okay, who's the target shareholder? Who's the target corporation? Who's the acquiring corporation? And then what is the question asking? Again, because you try to look at this just and start answering all the questions, I think things start jumbled up on. Okay.
So it'll be $250,000, $300,000 from
SCR will pay city the, and
And
SCR.
so that's just asking you what is realized, right? Realized is the economic exchange. Doesn't mean it's recognized for tax purposes. And so she's gonna get 300,000 of acquiring corporation stock. And she has a $50,000 basis in the target corporation stock. So if I give target stock for acquiring stock of 300,000, I have amount realized of 300,000, adjusted basis of 50,000, that's my 250. But it's only realized, right? Question now is it?
Yeah, so what amount of DMO do you recognize on the exchange for WB stock or SCR stock? Would it be zero because the person higher $150,000 gain is only stock, it's just
But I would also have to think, the authors don't say it, but I have one corporation acquiring all of the assets and liabilities of another, and as part of that transaction, the target corporation ceases to exist. I just want to be methodical and make sure I'm in the reorganization world. If I am, then it's non-taxable for the reason you just mentioned, say that it delivers, defers the entire gain realized because only stock is transferred. So that answers you're going through the target shareholder tax application. So we just answered the taxability. Right? If you go back, then you're going to ask two questions for each party to the reorg. You answered the taxability question for the target shareholder. Okay? Now the basis.
So what is the stock basis in the SCR stock? So it'd be $50,000 because it's higher to preferred. So say the stock basis in the SCR stock is the substituted basis from the WB stock. The first question, and this preserves the gain for future acquisitions. Say that you need to sell the SCR stock in the future for $50,000.
Just like we did in the 351 transaction where, did I get the right basis number here? Do an immediate sale check, okay? If she turns around and sells the acquiring corporation stock she received, it's worth 300. It's not gonna change in a day. And my basis, I think, should be 50,000. So I would recognize 250,000 on that hypothetical day one sale. Is that the same as the amount I deferred that was realized but deferred? The answer is yes. That means I feel pretty comfortable I got the right basis in that stock, that substituted basis. And again, that's indicative that the government is saying, I'm not going to currently make you recognize this, but I want to preserve that gain so that if you do something else taxably with the acquiring stock, I can tax it that. Okay.
What is the tax basis of each of the assets? SCR is the WB of the merger. So SCR is the carryover tax basis for each of the assets received. So the tax basis, for example, of the goodwill, and customer would be zero.
Yeah, so they didn't talk about the taxability to SCR, but you guys know from the prior couple slides, the acquiring corporation does not recognize gain or loss in an A reorganization. So then this asks the second question, they get all the assets of the target corporation, what is their basis in those assets? Well, it's non-taxable, so you're just taking a carryover basis in that, so you just keep on with the basis that WB had in those assets and you keep depreciating them. And that point on goodwill and customer list, those are self-created assets at WB. So you didn't acquire those in a taxable acquisition, so you don't get to step those up fair market value, right? That's what we talked about on Monday. If you bought the assets, you could step them up. Here you got them in a tax-free, non-taxable transaction, therefore you have to carry over the tax basis, carry over the depreciation. Thank you. So this is a example of a pure A reorganization, no boot. Right? No taxable. No taxability to any party, and you have substituted basis, shareholder level, carryover basis of the acquired. Okay, so 818. So this is showing you when I vary those facts, and I have boot involved in that same transaction.
So here's where we kind of take into account the boot. So this is where we get the what if scenario of assume Seda receives 100K in cash plus 200K in SCR stock in exchange for all her WB stock in a type A merger. what amount of gain will SATA realize on this exchange. So you basically just add the 100K plus the 200K to get the 300K minus the tax basis of 50K to get an answer of 250K.
Yeah, and that, so the amount realized, the gain realized is the same no matter what you receive, right? It's the value of what you get versus the basis you had what you transfer. So that's the same 250 in the example before. And this, structured correctly, this can still be an A reorganization, right? You have to test that, did I get too much cash? Cash is 1/3 of the total value delivered as consideration, and that's okay. I can go all the way up to 60% cash. So I'm still within the confines of an A, but I have boot, so somebody's gonna have some tax.
So then we consult the question of what amount of gain will SATA recognize on the exchange. This is where we get an answer of 100K, which is the boot, and SATA must recognize gain in an amount that is lesser than the gain realized or the boot received. So SATA defers 150K of the 250K realized gain.
Yeah, so this is just our old calculation. We have to remember the gain recognized as lesser of gain realized, which was the 250, or the boot received, which is 100, so it's 100. So of the 250 realized but unrecognized, I have to recognize 100 of that, because that's the amount of the boot.
And then last question is, what is SATA's tax basis in their SCR stock? So we use the computation of adding the gain recognized on the exchange minus the fair market value of boot, the cash received, to get a cash basis of the stock received of $50,000.
Yep. So read that last part. So
Yes. The calculation preserves the gain deferred for future recognition if SATA sells for SCR stock in the future for at least 200,000, which we get the 200,000 minus the 50,000, which equals 150K.
yeah, so I think that completes the basis analysis, right? Because we had 250 realized, we recognized 100 of it, so that means 150 remains deferred. So if I wanted to make sure that I assigned the right 50, the 50,000 was the right basis number for the stock that she received in the transaction, do an immediate sale check. Well, the stock I received was 200,000 because I got cash, so 2/3 of the value was stock. So I sell it for 200,000. If my basis determination was right, a 50, that would mean I'd have to recognize 150,000. Does that match my realized but unrecognized gain on the transaction? The answer is yes. 150 was what I deferred. So you kind of feel good at night that I got the right basis. Okay, thank you. Any questions on that? Yes.
I just want to quickly clarify the shareholder that we're talking about right now, like individual or the corporate, and then all the rules that we know, all those.
No, so this is just simply the mechanics of the transaction and whether that's taxable or not to all the parties. Okay, what happens going forward? You have to analyze that, like if there's going to be dividends that are paid out and what are those implications and those types of things. So if I answer your question correctly, this is just looking solely at the mechanics of this exchange. Can I do this? This is essentially an acquisition, right? SCR has come to you and said, we want to acquire the assets of WB. And we want to do that in a non-taxable manner, but in the second part of 818, the narrative would be, but the seller wants 100,000 in cash. Can I do that on a non-taxable basis? The answer is yes, I can do that on a non-taxable basis. So, yes, you have a lot of prospective things you got to think about, like does SCR pay dividends and what are those implications for the shareholders? Did I get your answer?
Yeah.
Okay. So yeah, this is just a point in time of that particular transaction. Is it deferred? And then going forward, I have other things go. Yes, Jeremiah.
Can you explain the check computation again? I'm a little.
Okay, yeah, the check computation. So think of the check computation as checking whether you put the right basis on the asset that you're talking about. So Jack went through it and he says, I want to put $50,000 of basis on that SCR stock that SATA as the target shareholder gets. Is that correct or not? do an immediate sale. The check computation is what would be the gain recognized if SATA did an immediate sale of that SCR stock. So go through and parse the facts. How much would it be worth? Be worth $200,000 because she got $300,000 of value. $100,000 of it was cash. $200,000 was stock. So the stock's worth $200,000. Sell it for $200,000. Jack says the basis should be $50,000. So that would mean my gain is $150,000. That has to equal my previously deferred, realized but unrecognized gain. And it is because I only recognized 150. I only recognized 100 of the 250 realized gain, leaving 150 still deferred. So I should equal, all of my gain should be recognized on an immediate sale. I mean, that gives you some comfort on the basis side. Okay, so that's a reorganization with boot. Okay. Now we're going to get into the exotic stuff a little bit. Okay, so this is an animal called a forward triangular A. Okay. So this is where the M&A stuff starts getting really complicated. But that's because the business world is very complicated, and there are issues that people ran into with doing a regular A reorganization that the business people want to say, well, yeah, but what about this? And I want to try to do something different but still get non-taxable treatment. So one of the disadvantages, potential disadvantage to structuring an acquisition as an A reorganization is that second requirement that the target corporation ceases to exist as a corporation. Okay? That sounds easy to say in a textbook or in practice, but to do that has ramifications. This can be problematic when the acquiring corporation is itself publicly traded. So if SCR, in our example, is the publicly traded company, usually you see in an org chart, the publicly traded company is devoid of operations, right? Lawyers, as a general matter, like to keep the public parent clean of any operating activities, so they own subsidiaries that have the operations in them, but the parent company is just an owner of all those subsidiaries. It's just force of habit. Attorneys like to do that. So if you do that transaction we just talked about, well, you populated your publicly traded company with the WB assets. You might have went 50 years without having assets in your publicly traded company, but now you just populated them in there. So somebody might say, I don't like that, but I still want to do a non-taxable transaction. How can I do that? So these issues can be avoided by considering a variation. That's why when you think about these triangular transactions we're talking about, it's just a variation, okay? But whereby the acquiring corporation uses its parent stock as consideration for the reorganization, commonly referred to as a forward triangle. It took me years, because I didn't have this when I was in school. I'm like, what are you guys talking about, these triangular transactions? I don't understand what they are. It's basically three parties to the transaction. So you connect the dots, it becomes a triangle. But it's always the acquiring subsidiary is below the acquiring parent company, and the acquiring subsidiary is using the parent company's stock in the transaction. And that's because you're trying to direct where the assets reside that you acquire. Okay, I'll show you a picture in a moment. But it's always think of you're using your parent company's stock as the consideration. Sometimes these are called simply a forward merger. So if you hear M&A people or investment bankers people saying, oh, we're doing a forward, that's what they're talking about. Forward triangular A. Fully transparent is what the tax people want to hear. Okay? So to qualify as being a non-taxable transaction, a forward triangular A must meet the following requirements. You must otherwise satisfy the requirements for an A reorganization. What we just talked about. Acquiring corporation must acquire all the assets of the acquiring corporation, and the target must go out of existence, and I have to own, I have to have at least 40% of acquiring stock involved in the transaction. 60% cash can't be over 60% cash. The parent corporate, so these are the new requirements in the triangular variation. The parent corporation must own at least 80% of the acquiring subsidiary stock. So the picture in the acquiring subsidiary, which is the surviving corporation after the reorg, must acquire substantially all of the target corporation stock. So this is setting up the triangular piece of the transaction. Okay? I don't expect you to be experts in triangular reorientation. I'm just going to give you a flavor of this so when you walk into a conference room, somebody's talking about these things, because at least you've heard about it, you can start asking questions about it, and when you draw out the transaction, you'll see it. Okay, so here's what a forward triangular looks like. So here, remember SCR was our target corporation. Our acquiring corporation. Now it's not the acquiring corporation. It sets up SCR acquisition subsidiary. So you hear lots of times when companies are doing M&A transactions, they set up acquisition companies. This is what they're doing. Setting up a brand new entity to function as party to the reorg.
A special purpose vehicle.
Special purpose vehicles. What they're trying to do is separate where the assets ultimately reside instead of where they would have been if you didn't use the special purpose / acquisition. They're all those terms mean a newly formed entity that doesn't do anything yet. You formed it as part of facilitating the transaction. So what SCR would do is went out and formed SCR acquisition company to do this transaction. Then drawing out the transaction, what happens is WB sends all of its assets and liabilities over to SCR acquisition subsidiary. An acquisition subsidiary delivers SCR stock and cash to SATA. SATA delivers WB stock to SCR Acquisition Co. And WB goes out of existence as part of the transaction. So what I've done here is the same transaction, but I introduced a new vehicle. I put the acquisition subsidiary in there, and that's because, let's say again, SCR is a publicly traded company, and I don't want operating assets in there. What this has done is I've separated where WB assets go. They stay down below the parent. That could be important in the business, depending on whether the company is publicly traded or not. Okay, so, and I put my little star by who's the surviving entity in the organization, in the business. And so, here it's the same transaction. They got the same cash, they got SCR stock, but the assets now reside one tier below SCR into SCR acquisition. Okay, separate from SCR. Okay. The key drawback of that, so what that's doing is just trying, I like to think of it as directing the assets. So the triangle aspect is because of this, these three entities. Okay. So I like to think of it as that's why the triangle reference is in there, and it's forward because my acquisition company, if I'm advising the acquisition company, it moves forward in time, meaning it is the survivor. The target goes out of existence. Well, it's triangular because I use my parent's stock part of the acquisition, and it's forward because I'm going to be the one that goes forward and have the assets in the my special purpose acquisition. Okay, so yes, Claude.
So as SCR, I think would still be the ultimate beneficial
Yes.
owner, right?
Yes.
But due to tax structure and legal structure, the buck stops with the SPV, the
Yes.
SCR.
Yes. So everything we talked about before, the premise is why this is still non-taxable. Think about what SATA owns. SATA owns SCR stock. SCR stock owns SCR owns SCR acquisition subsidiary, who then owns WB assets. So the reason it's non-taxable in part to SATA is because she still has line of sight to those WB assets. They're just two steps removed. Through SCR stock, through SCR acquisition subsidiary stock, down to WB assets. Partially taxable because she got cash. Right? that still holds. You can't transfer things and get cash and not have some taxable event. Yeah, so good. Okay. So now we have a second variation of A reorganization, which is a reverse triangular A reorganization. So a key drawback of an A reorganization, whether structured as a direct merger, that first example we went through, first exhibit and then the two examples, exhibit 8.8, or a forward triangular reorganization, exhibit 8.9, is that because Target Corporation ceases to exist, its contracts, think employment, licensing, supply agreements, must be addressed. If WB goes out of existence, every contract that it's signed, employment-wise, vendor-wise, IT, any of those things, has to be readdressed, right? It has to be recontracted. And where that can be is, depending on the terms of that contract, say it's a long-term supply contract, what if there's a provision in there that says if there's a change in control, then we need to renegotiate the terms of the contract? That would be problematic, right? Kind of redo the contracts. Maybe it's favorable terms. You don't get those favorable terms because the other party can invoke that provision in the contract to renegotiate the terms of the contract. What if WB, the target corporation, owns a bunch of assets that are titled in the name of WB, which they would be? All of those assets have to be retitled into the ownership of SCR in the first example, or SCR acquisition subsidiary in the second example. That's easy to say, that's hard to do. Some attorney is going to be just cranking out paper, right? Electronic paper, doing all the stuff to get that papered right for that ownership. The other thing you deal with is in intellectual property. Typically, companies have to register their ownership of intellectual property in every jurisdiction in which they are doing business or want to do business to protect their rights to that intellectual property. If you change the legal owner of intellectual property, you have to re-register that in every one of those locations. I have seen lawyers throw up their arms and say that is impossible to do. I have to do that in 50 countries. That's going to take a mountain of time and effort to get done. To which I say, get started. But it is an enormous undertaking. It takes a long time. It's easy to say, hard to do. So that's where, again, business wanting something that's easier, that's when this variation has come into the law. A reverse triangular A or reorganization. So it's triangular, so I'm still going to have that acquisition subsidiary in there, that three-pronged triangle, but they can be these issues of readdressing contracts and retitling of assets can be avoided when the acquiring corporation uses its parent stock in the form of an A reorganization, but not a forward, but a reverse triangular. Okay? Here, the target corporation is the surviving corporation in a reverse triangular. And there is no need to address existing contracts or asset titling. They kept the corporate feature of the target corporation in place. So there's no need to retitle things. There's no, the same corporation is still a party to the contract, so I don't have to retitle or readdress any contract. This is sometimes simply referred to as a reverse merger. This is very common in a publicly traded situation, structuring things as a reverse merger. So, to qualify for non-taxable treatment, a reverse triangular must meet the following requirements. It must satisfy the requirements for an A that we started with today. It has to be acquiring all of the assets and liabilities, and the stock consideration must be at least 40%. The parent corporation must own 80% of the acquiring subsidiary. That's the same as we introduced in the forward triangular. The target corporation must acquire substantially all of the assets of the acquisition subsidiary. So now we're going the other direction. See that in the picture. The target corporation is acquiring the asset or the assets of the subsidiary, the acquisition subsidiary. And the target corporation's shareholders must transfer control of the target corporation, and at least 80% of the total consideration received by the target must be comprised of voting stock of the acquiring corporation. they've added more requirements for this. But the benefits of this are pretty powerful for corporations. Let's look and see how this looks. I have the same triangular aspect, the three parties, the three corporations that are involved. It's a reverse triangular because the target corporation now gets my green star. It's the one that is going to survive. So the transaction is SCR forms acquisition subsidiary. Acquisition subsidiary then delivers SCR voting stock and cash to SATA. SATA delivers at least 80% of WB stock in exchange for that voting stock, and acquisition subsidiary merges into WB with WB surviving. Okay? So I have the same target shareholder, let's say our target shareholder SATA, same target corporation, and I have the same acquisition company and the same acquiring corporation. I just restructured the form of the transaction. So when the dust settles on this transaction and it's over, SATA owns SCR stock because that's what they received, and received cash to the amount possible. And then SCR owns WB. WB gets my green star and is the survivor. So it's separate from SCR. I can direct where the assets of the target corporation go. They don't go directly into SCR, which is our first starting point. And now WB owns the assets that it owned before and has all the contracts that it was a party to before. So in cases if there's a long-term supply contract that is favorable, still in place. My intellectual property that I'm exploiting all over the world, I don't have to re-register all that. Still in the name of WB. Okay? So I've essentially stopped having that asset transfer. I got all the assets in a corporation, but I used the target corporation to do that. Jeremiah?
So technically WB would be like a subsidiary of SCR?
Yes. Okay. Yes. I've just pulled it over, which if you think about in the publicly traded space, that's an ideal way to acquire a target corporation. If it's a new division or new geography that I want, I just moved it underneath the parent corporation in a non-taxable transaction. Unless I have some boot and then the target shareholder has some boot recognition. Okay. Okay. So yes.
Question. So you said that parent acquirer company should create a sub account prior to the acquisition, but that sub account the sub company doesn't really have any assets to transfer. I would assume, for example.
Correct. So what happens is they don't show it on this picture, but see, SCR is delivering to SATA SCR voting stock and cash. There has to be a first transaction where I give the cash and my parent stock to the subsidiary so that they can deliver that. But you're right on. When I form the entity, it doesn't have anything, so it can only get it from the parent.
So parent cannot directly transfer to a SATA. It should transfer to a sub account, sub company, and then.
Correct. Because I need a merger in the transaction, and this affects the merger because my acquisition subsidiary and WB combine as a function of state law. That statutory merger that we started with. If I did it directly, I wouldn't have that merger. It wouldn't be a B reorg because we're going to talk about in a B reorg in a minute. I have to do all stock. So if I did all stock, I could be. But this is a situation where SATA apparently wants some cash. So I have to then find a different way. So this is what you always end up with, is you find out the needs and wants of the parties, and you try to shoehorn them into a particular form of reorganization. And luckily, there's a lot of different variations that I can get to that cover a lot of permutations. And I have to get to the right one that fits my facts. Yes, George.
So for liability reasons, is your subsidiary the one liable?
So for liability purposes, when the dust settles, SCR will own WB, and WB will still be a corporation, right? So any liabilities of WB will not be the problem of SCR, because it'll be limited liability in the corporation of SCR or in WB. That answer your question? Yeah. Yeah.
So does it mean all these that we're talking about?
No, they can be foreign corporations. So when it says there must be a statutory merger, you can do that statutory merger under foreign law. So if this was down below in your group and you had foreign entities that you were acquiring, you just need an equivalent foreign law that functions as a state statutory merger. You can find that. Not everywhere, but you can find that under foreign law. Now, if you don't have that in your particular law, then you got to jump to one of the other types of reorganizations and see if you can do it that way. So I always thought of myself as a tax planner as trying not to get boxed in. So if I got shut down this way, I would go over here. If I got shut down there, I'd try to go this way. It just might be really hard to box in because I want to find a solution, some way to get it done. Yeah, Jeremiah.
Is there an amount of voting stock that has to be transferred to SADA?
Yes. So that is the last consideration here. At least 80% of the total consideration received by target must be comprised of voting stock of the acquiring corporation.
So SADA would be the new control of SCR?
No, because it's not 80% of SCR stock, it's 80% of the total consideration. So if SCR is huge and WB is small, she can still get 80% of what she gets paid in voting stock, but she'll be a small shareholder of SCR. So it's all who's big and who's small at the end of the day.
80% of WB of the cost price of WB should be 80%
80% of WB stock is exchanged for SCR voting stock. So it's just looking at the relative values. Now, if SCR was small compared to WB, just relative fair market value, she's going to be a big owner at the end of the day because she's going to get 80% of her return, or her exchange is going to be the target or the acquiring corporation stock. Questions? Okay, so let's take on B reorganizations because that came up here. So again, this is a B because it's this next sub-paragraph of 368A1. So B reorganizations are commonly referred to as stock for stock or share for share reorganization. Doesn't matter if somebody calls it share for share or stock. That's one of the terms that I'm not, for some reason, doesn't bother me. If you want to call the ownership of a corporation shares, or you want to call it stock, I don't care. I think it's the same. So if somebody says share for share, that's fine. Stock for stock, same thing. Okay. So the statutory requirements for a B reorganization, they're different from an A. Why we have an additional version here. The acquiring corporation must exchange solely voting stock in exchange for stock of the target corporation. So the only consideration that can be delivered by the acquiring corporation is its voting stock. And the acquiring corporation must control, I mean, they get at least 80% of the target corporation after the transaction. Okay? That's my two requirements to get into a B. The above requirements are strictly construed. That's what I was mentioning to those gentlemen. The inclusion of any consideration beyond the voting stock of the acquiring corporation taints the entire transaction and subjects the parties to the reorganization to current taxation, unless I can jump to one of the other types of reorganization. Okay, so I see B reorganizations as some of the biggest publicly traded companies when everybody wants non-taxable treatment. If the only consideration I'm giving as the target, as the acquiring company, is voting stock, then there could be, by definition, no boot, right? Because it says solely voting stock. So the allure of this is if I get into this, everyone's non-taxable. Which is really nice. If I'm buying a big, large target corporation, I'd like to have no one pay tax on that because there's liable to be some big tax bills. Okay, so B reorganization is pretty simple to look at. This was mentioned up there. So SCR would deliver voting stock, its voting stock, to SADA. SADA gives at least 80% of WB stock to SCR because the second requirement is the acquiring corporation, SCR, must control the target corporation after the so it needs to own greater than 80%, at least 80%, sorry, of WB. So the reason this is non-taxable is because SATA still owns WB stock indirectly through its ownership of SCR. Right? I used to own it directly, now I own it indirectly through my resulting ownership of SCR. SCR owns at least 80% of WB after the transaction. I label all of my parties to the reorg here. SATA is the target corporation shareholder. WB is still the target. SCR is the acquiring corporation. Okay? So we're going to do the same methodology we did before. The acquiring corporation tax implications, taxability, no gain or loss to SCR in the transaction. Delivering solely voting stock in exchange for WB stock is a share for share exchange, not taxable to the acquiring corporation. You guys can probably tell me now what the basis rule is going to be here. It's going to be carryover basis, right? Because SATA did not pay tax on her gain in WB stock. I'm deferring that. I want to preserve that in the hands of SCR owning WB stock. The way I do that is the WB stock moves from SATA to SCR. I want to carry over the basis, follow the asset. So the acquiring corporation takes a carryover basis in the target corporation stock equal to the tax basis, target shareholder, add in the stock of target corporation. In the case of a widely held target corporation, the IRS allows the acquiring corporation to determine its tax basis in the target using statistical sampling. So if I go back to this example, let's say WB is a publicly traded company. It has hundreds of thousands of shareholders, right? I do this transaction. We just said SCR will not pay taxability. What's SCR's basis in WB stock? Carryover basis. You're telling me I got to go out and find hundreds of thousands of people's basis in a publicly traded WB, and that becomes my basis in WB? Yes, that's the rule. Well, that's practically impossible, right? You're going to have people you can't find. You're going to have people who won't respond to you, right? So the government allows the acquisition of a publicly traded target in a B reorganization. You can apply some approved statistical sampling rules to try to approximate what that carryover basis amount is. Because the government understands you cannot get that to the precise nickel, right? So, I always like to think there's a grandma out there who owns some stock and she doesn't even know she owns it. You're not going to get her attention and find out what her tax basis is. It's not going to happen, right? So there are certain methodologies there that firms will help you to try to approximate what that tax basis is. But the rule is you have to take carryover basis. Okay, now target corporation tax attributes, so that we're talking about WB here. Taxability, no gain or loss is recognized. The tax basis in their assets, they didn't do an asset transfer. When I look at this picture, what did WB do? Nothing. Just its owners change hands. So you would think nothing happens to its tax basis. Just keeps on keeping on. Right? Wherever you are on your depreciation methodology, you just keep going. Nothing to be done. You didn't transfer any assets. SATA, so the target shareholder tax implications, no gain or loss recognized. Can't have boot in a B reorganization, so all she can get is voting stock of the acquiring corporation. So she has no gain or loss recognized. What would you think the tax basis is in that SCR stock she gets for the WB stock? That's just, substituted tax basis. The substituted tax basis is to preserve that gain she has realized in the WB stock, but she doesn't recognize by virtue of this transaction. Therefore, she substitutes her basis for the WB stock into her new SCR stock. Do the check computation. If she immediately sells that acquiring stock, that gain that she realized but didn't recognize is going to be then recognized, right, of the substituted basis.
So in the instance where it's a private company being acquired, like the 1,000 shareholders.
Yeah.
Do they all receive voting stock? How does that?
Yes.
Stock?
Yeah, so if your shareholders were like 5 Setas, Seta and 5 members of her family, because they all started WB, then each one of them would have to get at least, would all, for a B reorganization, have to get voting stock of the SCR in this example. Then, in that scenario, you should be able to get their basis number, right? You'd put that in the contract, say, you need to tell me what your basis is because SCR needs to take a carryover basis in WB stock, and you should be able to find that out. You don't have that problem of the grandmas that are, you might have a grandma with you need to help her. So, good question, but yeah, you can have fact patterns where there's more than one shareholder. Each one of the shareholders has to agree to this transaction. That's where, if you had one of those shareholders who said, no, I want cash, well, I can't be in a B reorganization. I have to see if I can I do it as an A? Can I do it as a reverse triangular A? And this is why these projects take so long. It's because the design of the transaction, working with the business people, the investment bankers, the lawyers, and trying to get everybody lined up. And you might have multiple stakeholders. It might not be as easy as just talking to SETA. What do you need in this transaction? You might have 5 SETAs that you all have to satisfy. Okay, so substituted tax basis in the acquiring corporation stock received equal to their tax basis in the target corporation stock. Let's do this example real quick. Who's got 8? Yeah.
Suppose SCR will exchange SCR voting stock for all of Seta's WB stock and WB stock for the organization. Seta's tax basis in WB stock is $50,000. The fair market value of SCR stock is $300,000. What amount of gain will Seta realize on the exchange of WB stock for SCR stock? So she will realize $250,000 because $300,000 minus $50,000, the difference between the SCR stock and the WB stock. What amount?
Well, let me make sure I get it. So the value of the SCR stock I get with the basis I have in the WB stock. So right, that's the economic exchange. So I have $250,000 realized, right?
What amount of gain will Seta recognize on the exchange of WB stock for SCR stock? So she recognized nothing since she defers the entire $50,000 gain realized because only SCR stock is received with WB. What is Seta's tax basis in the SCR stock? It's $50,000 because the entire gain is deferred. It's a substitute basis from the WB stock, which means it preserves the gain deferred for future recognition if Seta should choose to sell the SCR stock in the future for its fair market value of $300,000.
So you can do a deemed day 1 sale, next day sale, sell it, its value is $300, I sell it for that. I want to say substitute basis is 50, I recognize it at 250. Well, that's what I deferred that was realized.
What is SCR's tax basis in the WB stock received from the exchange? $50,000 since it receives carryover tax basis equal to Seta's basis in the WB stock.
Yeah, so this is SCR will now own WB. What's its basis in WB? And again, since no one paid tax on this, SCR, the value of WB will be $300,000, and I want to preserve that, so I have a carryover basis in that. So then SCR takes a $50,000 basis, which was Seta's basis in the stock, carries over, follows the asset.
What is WB's adjusted tax basis in the asset after the exchange? So it would remain the same since the goodwill and customer list.
Yeah, so your good check computation is there. If WB sells their assets, it's going to have the same gain or loss that it would have had if it never done this transaction and sold its assets, right? Nothing's changed. It did not have a transaction.
Suppose Seta received $10,000 plus $298,000 stock in the transaction. How does this change impact Seta's tax consequences? So this would no longer qualify as a Type B reorganization, and the entire realized gain for it to be a type B rated organization, she can't receive any cash.